Jason, as we head into the summer, where do you see the current credit environment?
Yeah, the picture on the credit environment looks pretty good at the moment. So if I start from a fundamental perspective, I think that inflation is probably going to decelerate over the back half of the year. I think the growth is slowing, and employment still looks pretty good, which I think is a pretty good environment. Expectation that the Fed likely cuts rates in the back half of the year to some degree. And from a credit perspective, when I think about all-in yields on bonds look great for us from an investment perspective. So despite the fact that credit spreads are at historical tights, the technical backdrop is fantastic. We're just seeing a lot of demand, and as we look at the fundamentals of corporate borrowers, they still look pretty good. So expect to see some deterioration with the economy, but deteriorating from a high level, and a great opportunity for carry in the credit markets.
Well, there's certainly a lot of demand for private credit. Everyone wants to be a lender nowadays. Is that a crowded trade?
Well, I think there's a lot going on. When you talk about private credit, it's not a monolithic asset class. So as an insurance company, for example, we've been in private credit for decades, and that's where I started my career, actually, is in private credit. And when I joined Lincoln, 2013, we couldn't find enough private credit. It was hard to find, right? It was, we invested kind of 20 to 30% of our $15 billion or so a year that we invest in the markets into private credit. Now we're seeing more opportunities. So we see we're able to invest 60 to 70% into private credit, but it's gone from small companies to large companies, and the private markets have really grown and really matured. Issuers like it. We're seeing more issuers come to the market. There are more private companies now than ever, and we're seeing larger companies, not just small companies anymore. More 87% of companies that make over 100 billion in revenues are private, and those companies are choosing to finance themselves in a mix of the public and private markets. So I think it may be a crowded trade. Parts of it may be crowded, but I do think the markets are maturing. You're seeing bigger companies, bigger issuers, better, broader participation. So it's a space we like. I think you need to be careful when it comes to private credit. For Lincoln, for example, we're a long-term investor, very permanent, patient type of capital. We can match assets and liabilities. So private credit's fantastic for us to earn incremental yield premiums and pass that through to our customers.
Well, one big area within private credit is commercial real estate. Do you have any worries about commercial real estate? Because a lot of people thought that was going to bring down the overall economy not too long ago.
Yeah, I think there's right to be concerns around commercial real estate, but it's also hard to paint commercial real estate with one big broad brush. So you have office real estate, for example, is going through a bit of a transition. I think that's going to take time, and I do think we'll see some bumps and bruises there. But when we zoom back out and think about commercial real estate more broadly, you have great fundamental underlying characteristics around industrial and apartment and other subsectors there. So feel pretty good overall about it being an investable long-term asset class. Again, if you have the right liability structure to manage for the long term, which as an insurance company we do. When I think about our portfolio specifically, we have primarily invested in investment grade commercial mortgage loans, fixed rate, longer duration types of properties, and we had reduced our office exposure by 600 basis points coming in really over the past 5 years. So we feel good about where we're positioned. And I think commercial real estate, while parts of it will go through bumps and bruises, and like they say, real estate is local. So very specific to the properties as well.
Can you expand a little bit about your positioning overall when it comes to fixed income?
Yeah.
Govies, munis, high yield. What do you like the best?
Yeah. So we run our general account is about a $100 billion portfolio. So focus in on that. And it's invested, we're basically investing the premiums that come in from our policyholders. So it's asset liability matched. And as you can imagine, it's pretty high quality in terms of the fixed income allocation. So we're actually sitting here today, the highest credit quality we've had, certainly in my tenure at Lincoln. They're about 97% investment grade fixed income. We do have private equity and some other asset classes seeking incremental yield. But we have a mix. It's one of the highest quality portfolios we've had. And we really keep a diversified portfolio. As I mentioned, private assets play a big role. We've been diversifying out in terms of private assets, structured assets, where we think we can earn incremental yield premium while staying up in quality, making sure that we get the benefit of diversification without compromising the credit quality of the book.
And then finally, you seem awfully positive on the remainder of the year. If there's going to be something that really undoes the fixed income market and the equity market, what's it going to be? Is it the election? Is it going to be earnings? Is it going to be a commercial real estate collapse? What will it be?
Yeah, I think we say at Lincoln it's about investing in preparedness, not prediction. I don't know what it'll be necessarily, but something could certainly unseat the trends that we're on today. So I do think it's important to prepare through downside protection strategies of that nature, which is something that we're very focused on. When you mentioned the election, I think the election is interesting because it creates an opportunity for volatility, and the thing that markets hate the most, just kind of the uncertainty that comes with that. But as you look out, and we corral the views, we have a great multi-manager platform. So we have $300 billion in assets. We manage with our partners on that, and we're able to get all the views from the top blue chip asset managers in addition to our team, put that all together and get the views out there so that folks can kind of distill down and get a sense, cutting through the noise. I think there's going to be a lot of noise. I think the elections bring noise, but if you look back through history, if you're long-term investors, markets are agnostic in terms of which party wins the election. If we went back to 1965 and looked at the 10-year returns post an election year, and whether a Democrat won or a Republican won, you saw about an 11% return over the next 10 years. So we'll probably see some bumps and bruises. Who knows what it'll be? Hard to bet on the prediction there. But I'd be a long-term investor. I'd focus on preparedness and having good downside protection.
All right. Well, thanks a lot for coming on and talking about it.
Thank you.